number 7 on portfolio theory, zooming good, right? And we do chapter, is it chapter 8, efficient markets, right? 8 efficient markets. So this is a topic which, of course, professors and researchers in finance love. This is the hottest topic in finance. It has been for the last 20 or 30 years because, as you understand and know, it is a fertile ground for research. You crank out another regression or a random walk test, you can publish another paper. So, what does efficient market mean? The efficient market means that markets incorporate information quickly. When a new information comes, the market incorporates it usually within a minute or 2. Rarely it takes more than 5 to 10 minutes for the market to what we call absorb the news or to reflect information in the news. So an efficient market means that as soon as the information is out, the market will react, usually within a matter of 20, 30, 50 seconds. And then the market will have a secondary reaction, maybe 3, 10, 15 minutes down the road. Usually what we call when traders digest the news. To digest the news actually means that they did not look at what's called the headline number, but actually look into the details. In other words, the news will be associated with some particular details. When they read the details, and it may be 1, 2 pages, they'll actually try to figure out what they mean and adjust a little bit. So the primary jump of the market could be on the way up or on the way down, will absorb maybe 90% of the move on the news, could be 95, and then 5, 10 minutes later there will be a little more adjustment. Another example will be mergers and acquisitions. You get a news about a merger, and when you get the news about the merger, usually on the press release the price will jump. Sometimes on mergers, the price will fall. For example, company A is acquiring company B, and A is, according to traders, perception is that they are overpaying for B, and they're actually getting a net negative value out of the merger. So, when they get net negative value out of the merger, the price of A would fall, reflecting that expectation. Well, sometimes corporations will do another trick. They will fish the market, and to fish the market, now what's to fish? They'll try to see if something will be liked by the market or not, and they will either leak the news or they will actually announce an intention without actually meaning to execute or follow up unless the market reaction was really good. So once they see what the market's reaction, oh, the market likes it, then we'll go ahead and do it. If the market doesn't like it and goes down, then they'll, in a couple of days come back and say, okay, well, it didn't work out or whatever the reason. They'll always come up with an excuse. All right, so if this is the case, one of the most, let's write it in red, fundamental concepts is that of a random walk. Random walk simply means that the price behavior, the price of the stock, behaves as a random walk. And a random walk is a mathematical process which has no memory, and the future does not depend on the past. It also means that changes or increments, each next change, does not depend in any way on the past. This simply means that if you have the price, it goes up, down, up, down, up, down, 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 up, down, So it just moves in purely random fashion. So it is just as likely to move up as it is likely to move down. It is likely to have a fairly large move on the way up or on the way down, but it's also likely to have a very small move on the way up or on the way down. So, one key characteristic of a random walk is that it is unpredictable. Similarly, or it's almost the same meaning of unpredictable, is to say that increments, an increment in this particular case means price changes are independent. Independent. The independent has the meaning that the future move does not depend on the past. In other words, if you simply know the last 50 days, or the last 100 days, or the last 1,000 days, or if you have enough history of a couple hundred years, last 10,000 days, you cannot say much, or you cannot say anything to forecast tomorrow. The saying is that, you know what's every Wall Street trader's dream? It's very simple. To have today, tomorrow's issue of the Wall Street Journal. So you can see when the market closed, all right, and trade on it. In other words, the market is, in essence, unforecastable. Unforecastable. You cannot forecast the market, especially based on history. As I already mentioned, it also has a very different meaning, the meaning of information. Information is incorporated in let's say current price. I was about to say prices, but let's say in current prices. And we also want to say all information is available means incorporated, or instead of incorporated, say reflected in the current prices. Alright, so this is what random walk means. The essence of the, number 5, my mistake. The essence of a random walk is that the price, and by this I say the next price, tomorrow's price, is after all random. Well, random means unpredictable. Of course, it means the increments are independent. It also means that it's unforecastable. So I am giving you the intuition behind what random walk really means. Alright? I mean, it's like flipping a coin. You can flip a coin 50 times, you can observe what it is, and still on the 51st time, you cannot make a better prediction than 50-50, provided that the coin is fair, right? It's the same story with the market. Alright, so let's see what we have. Let's see what's next. Now, out of this random walk has come the so-called efficient market hypothesis. This is simply a hypothesis which states or stipulates that the market, by market we definitely mean the stock market or sometimes asset markets, but we certainly mean the stock market. We also imply the same for commodity markets, in other words, for all exchange traded assets, all right, for all exchange traded assets. Why? Because for real estate, you actually observe the price 3 years ago, 2 years ago, last year, this year, you already see a meaningful trend. When you see a meaningful trend, you can actually expect that next year the trend will persist. You were seeing like 5% growth, 6% growth, 5% growth, 7% growth in real estate prices. For next year, it is reasonable to expect maybe 6%. In other words, for those prices, we're not talking about prices like real estate, but we're talking about prices like oil, right? Now, if prices for oil, especially short-term prices for oil were predictable, those that could predict them would retire, right? They'd be billionaires. Alright, so random. Now, here's another tricky part, which is, again, very controversial, is we're mostly talking about short term. In other words, this is the controversial part. According to the efficient market hypothesis or random walk, you cannot forecast even the long term. Even the long term. But for many, actually, they really accept the idea, yeah, you can't really forecast it 1 day or 1 week out, but when you get 3 years or 5 years, the market is forecastable. Of course, forecastable within reasonable range, like, oh, we expect now oil is $50, we expect 3 years from now to be $120, maybe plus or minus $10 up or down, alright? So, why this forecastability of the market, which is in total contradiction with the efficient market hypothesis and the random walk? And the answer is, in the short run, randomness dominates market movements, while in the long run, fundamentals will dominate the movement. In other words, if you can forecast in the long run by using the fundamentals, you're essentially saying that you can actually beat the market. If you say, oh, I can forecast the stock market 3 or 5 years out, or oil 3 or 5 years out, then you're effectively saying that the stock market is not efficient, all right? So, again, many people think about it in the short run, but technically, it also applies for the long run. Of course, we expected oil to be 140 3 years from now, then it will make sense to buy now, immediately, drive up the price, right? Because a lot of people try to do this. They'll drive up the price, and rather than being 50, based on this expectation, it will actually drive the price a lot higher, almost 140 or almost 120, whatever our expectation is. Alright, so efficient markets hypothesis essentially says the market is efficient. This means it incorporates information efficiently. This means that new information is incorporated into prices almost instantaneously. Okay, so let's see now. The next topic is to understand that the efficient market hypothesis has 3 versions, has 3 different versions, 3 different formulations. The first formulation is related to past prices. We call this the, let's do this. Weak form. Weak form. So, the weak form of efficiency or of market efficiency states that the current price reflects all information available in past prices, and by using past prices you cannot, and the current price, you cannot predict the future price. In other words, analysis of past prices is totally futile. It is worthless. It will do you no good. This is the weak form. The semi-strong form says that all publicly available information, is completely reflected in the price. It simply says that as long as the information is published, maybe in the news, maybe in the media, maybe in quarterly accounting reports, filings with SEC, etc., the price will certainly reflect it. Alright? So, if you're trying to analyze accounting statements, you will not be able to gain extra information. And finally, the strong form. The strong form says that all information is incorporated. Well, what's the difference between public information and all information? This is mostly private. Well, yeah, but we don't call it private. We call it insider information. Insider information. In other words, the strong form says that the market price already reflects even insider information. It even says, essentially implies that even insiders cannot possibly trade profitably on their insider information. Well, let's define who are insiders, just to be sure that in an introductory course you actually understand who are insiders. Number one is managers. These are the easy ones that every student knows. Who else?
CFOs.
Accountants will be the next one. Financial analysts, no, they don't always have inside information. Sometimes they can obtain it, but financial analysts usually work with public information. Back in the good old days of the dot-com era, actually, financial analysts would be gaining inside information, and they will use it in their analysis for their ratings of the company, buy, sell, hold, whatever. But there's been a law which has prohibited them from using that type of information too. So, who else? Lawyers. Lawyers will have certainly inside information. Alright?
What's your board of directors, founders?
Yes, board of directors will certainly have inside information. Actually, a lot of inside information. Alright? So these are all insiders. They have information.
It's illegal in some cases. Insider trading is illegal, right?
Insider trading in most countries in the world is illegal. In the United States, it is strictly illegal. Yes, but they do it all the time, right? Well, this is what makes America great, guys. If you get the inside information, you can trade and make profits out of it, right? And if you happen to be 1 in 100 with a brand name like Martha Stewart, you might get a slap on your hand. But how much did she have to pay a penalty? No, she had to pay like a couple of million for a profit of $60,000. So she profited $60,000. Well, they had to actually show to the people that they're actually enforcing the law. Well, everybody knows that out of 100 cases of insider trading, usually one is prosecuted and actually proven, and 99 of them just go through. Anyway, so insiders can't make profitable trades. Now, let's move on to see on section 8. So all I did now was basically explain what does it mean, efficient market, and implications. Implications. So, implications simply means that efficiency implies a number of things. So, it means first and foremost, it implies that prices will follow random walk. The second thing which implies it follows out of the random walk, or it follows out of efficiency, is that technical analysis doesn't work. Technical analysis is a type of investment analysis which uses charts and graphs of past behavior in order to establish particular patterns and help a trader or investor invest better, maybe forecast the short term, maybe the mid-term, maybe the long term, etc. I will not spend any time now on technical analysis, simply because I'm going to be spending a couple of weeks, the next couple of weeks, 3, maybe 4 weeks on technical analysis. You'll get a very detailed course on it. So, technical analysis is worthless. So, we will spend 4 weeks to find out, is it really worthless? How worthless it is, or maybe why sometimes the efficient market hypothesis would conclude that technical analysis doesn't work, but we'll find out certain patterns and why actually the tests used to test the efficient market hypothesis cannot capture certain price patterns. So this will be coming in a couple of weeks, but you just have to know, if somebody believes in the efficient market hypothesis, oh, markets are efficient, man, there is no point in even bothering to read prices and price data. Well, here is another one. Fundamental analysis. Fundamental analysis certainly doesn't work according to efficient market theorists. Well, for this all you need is the semi-strong form, which simply says that all public information is already incorporated into the prices. In other words, if all information is there, well, what is fundamental analysis? You are looking at public information about earnings, profitability, assets, liabilities, liquidity, all sorts of other things, maybe the whole industry, maybe the whole economy, and you're simply told, well, this doesn't work, and this won't work, and this won't work profitably. And if it works profitably, maybe it's just a pure luck, right? But let's make a very quick note here. Warren Buffett uses mostly, if not entirely, fundamental analysis, and he has proven them dead wrong, all right? So he's been using fundamental analysis for a good 50 years, well over 50 years. He's now, what, 76 years old, right? So he's been using it for about 50 years, and he's been using it consistently and very successfully. Now, let's throw in another one, which is not in the textbook, but we should mention it. Behavioral analysis will not work either. Will not work either. In other words, trying to analyze people's behavior and whatnot will not work either. Now, why is this? The idea is that rational investors, and rational type of investing. Rationality implies good technical skills, good fundamental skills, implies that there are no behavioral patterns which imply lack of rationality. Is that rational behavior actually implies efficiency. So, rational, if investors are rational, it must be that the markets are efficient. In other words, rationality implies efficiency. Well, what behavioral finance and behavioral analysis does is study the patterns by which investors make their decisions and finds faults with rationality. In other words, when investors make decisions, they don't always invest in perfectly rational manner, all right? For a whole number of reasons. For example, real estate over the last, 3, 4, 5, 6 years, they all invested with the idea that real estate will always go up no matter what. They always invested with real estate with the idea that real estate is the safest investment in the world. Well, it is certainly not. It is naive or plain stupid to even believe that real estate is the safest investment in the world. And here's another thing which was in total and complete contradiction with elementary common sense or elementary portfolio theory. They believed that real estate was the safest, but they also believed that real estate would give you great, if not extraordinary returns. In other words, they expected huge returns for little or no risk. Well, but of course this is impossible as long as too many people figure it out. They'll drive the price of real estate up so high that the returns will not be abnormally high. They will be normal or maybe abnormally low when sufficiently many people drive up the prices. So you have these behavioral patterns. Typical behavioral pattern, for example, will be like this. Let's provide a couple. Let's behavioral finance. Let's do some of this. I get back from the United States with my doctorate. I've done a lot of investing, like 7, 8 years of investing. I studied real estate markets for many years and whatnot. I get back home to Bulgaria, and guess what? Everyone teaches me that the greatest investment in the world is real estate. And no, guys, this is an obvious bubble. They say, no. Bulgaria is entering the European Union. We are going to be the world's tourist destination. Rich Europeans, like from Sweden, from Norway, from Great Britain, even rich Arabs, will be coming here on the Black Sea. Of course, most people haven't heard of the Black Sea anyway. They don't care about the Black Sea. But people believed it. They were very naive. So I explained to them in great detail, well, no, this is what it is. This is how it works. This is what it is. And they told me, no, you don't understand anything about finance. Too bad for you that you wasted 10 years of your life on investing when you haven't even learned the simplest lesson ever in investing. That real estate prices always go up and that real estate prices never fall and real estate is the safest investment. So I've wasted my whole damn PhD because I didn't learn the simplest lesson. And everyone knew it. I was the only person in the country who didn't know it. Well, guess what? You have, at least let's call it in Bulgaria what it is. We have in Bulgaria gypsies. You know what's a gypsy? They're nomads. They're little tribes. They walk from one place to another, usually on their horses, and they use their carts, you know. These guys have no education whatsoever. You rarely see anyone who has completed high school. Most of them have never completed middle school. Small percentage of them will have like primary school, 3rd grade. And maybe 10 or 20% will be actually able to read.
And that's because the government doesn't help.
No, we don't give a damn why they're illiterate. The fact is, these guys are illiterate. The fact is, these guys can't read, okay? These guys can't write their name. These guys have never had their education in life. But these guys know that real estate is the best investment in the world, and they've gotten themselves big time on borrowed money by banks or whatever money they have, investing in real estate. They've turned themselves into real estate developers. They've turned themselves into real estate entrepreneurs. Well, these are the same guys who for hundreds of years, you know, have been living this nomadic lifestyle. So suddenly these guys are, you know, into real estate. You get retired people putting all of their life savings into real estate because real estate is safe. The safest in the world, all right? So suddenly you have the whole nation getting into real estate. It's kind of like what's been going on the last, 5-6 years in Dubai, right? The same story. Everyone's investing in Dubai. Isn't that kind of like the hottest? Well, you got one hell of a real estate bubble now, right about peaking and right about to burst. You know, how's Peter Schiff saying it at the beginning of every show? It's a bubble in search of a pin, right? It's going to find one, right? So essentially, every bubble, you know, eventually will burst. That one is clear. So the point of behavioral finance is suddenly the whole nation is telling me, oh no, everything's great. A year ago, November 2007, Bulgarian stock market was, you know, before that it was providing some extraordinary returns. 30, 40, 50, 60%. You guys in your own bubble here, right? Real stock market bubble here, which practically burst, what, 1 or 2 years ago?
Yeah,
right?
3 years ago.
3 years ago. So we had this wild bubble. Everyone was making money in Bulgaria, and I published, you know, nice article materials that this is a wild bubble, the stock market is going to crash and burn, all bad stuff. They pilloried me. I was incompetent. I didn't know what I was talking about. I hated the country. I hated the nation. I hated the people's prosperity, that everybody made money. The comments were of the sort, most of them were the sort, oh, he completely failed for 10 years in the United States. So, as a failure, he's coming back here to teach us about our stock markets. But guess what? They're telling me, you're clueless and know nothing about the Bulgarian market, and we're the market geniuses, right? Let's try a very common mistake made by investors. This is the most common mistake you will see everywhere in the world of investing. Investors always mistake bulls with what?
Bears.
With?
Bears.
Brains. With brains. Every time they see a bull market and they're on it, they think that because really smart. They're making a lot of money. Alright? So, these guys told me all sorts of things. I mean, I have got hundreds of hate emails and all this kind of stuff. Well, back then, guess what? The market was 1800 was there. The market peaked at 1950. Wow, this is going to be 1 year ago. November last year. Exactly 1 year ago. About the 20th. Today's 20th. So, guess where the market is today? Bulgarian stock market, the index. Where it is today.
500.
They wish. They would wish it were 500. They'd be happy if it's 500. More like 350, but it fell under 300 2 days ago. Recovered big time, alright? So, 350 now, meaning close on Friday, but it was 300. So, you can see they lost. Out of 6,000 invested in the market, 5,000 were lost and they were having only 1,000. And when I told them, look guys, you're going to get, stock market's going to fall 10 to 20 times, they said again, the same old terrible things. Well, guess what? Part of behavioral finance. Now, no one is saying the word like, oh, he was right. No, nothing like that. Every time they say the same story. The market is just bottomed, and the market is recovering now until the next leg down. Again, we'll do a lot more behavioral finance, but you got the idea, right?
Yeah. What about the real estate prices?
Okay, let's not discuss real estate now. Let's try to focus on the efficiency and rationality and whatnot. You mean what happened with Bulgaria's real estate? Oh well. Up until and including the credit crisis this summer, the firm belief was that Bulgaria is or has the strongest economy in the world and will not be affected in any way by the crisis. This was done by stupid Americans, and only Americans will suffer and Bulgaria will not be touched. Just like the GCC, right? Of course, the belief was incorrect, because if you hold the reserve currency of the world and the reserve currency weakens and there are problems with the reserve currencies of central banks and you have the so-called propagation or contagion effects, the thinking was shockingly primitive in Bulgaria. And you'll tell me it was the same thinking here. They said, oh, our banks don't hold subprime mortgages. We don't hold toxic assets. So, if we don't hold toxic assets, we're not going to suffer any losses. If we're not going to suffer any losses, the banks won't suffer any losses. We're not going to be affected in any way. Right? We're bulletproof. Well, the problem is different. The problem is that credit, as it flowed into reserves into European countries were growing their reserves. Central banks were growing these reserves. In other words, as the U.S. runs current account deficits. Current account deficits means that the U.S. prints money. The printed money ends up in European central banks and ends up in GCC central banks, ends up in the central bank of China and Japan. So these central banks in turn expand wildly in order to support the exchange rate parity. Alright? This happened here in every country in the GCC, in Japan, in China. So, the credit expansion itself caused, in turn, bubbles in Eastern Europe. Well, these bubbles must sooner or later end. Usually they end because profitability runs out. In other words, it's no longer profitable to buy real estate. I mean, you've heard it all from Peter Schiff about real estate. Somehow, it's no longer profitable. Somehow, everybody's got a house, and then a second house, and then a villa on the beach, and then, everyone is fully invested and fully borrowed way beyond their ability to repay ever. So somehow you run out of buyers, somehow you run out of investors, somehow you run out of speculators, you run out of resources. The economy has its limited resources. And when this happens, suddenly what happens is the markets begin to realize that the growth is not there. Well, if real estate prices don't grow anymore, don't grow as fast, and you're a speculator, what's the smart thing to do? Sell now. In other words, sooner or later, investors realize there is no point in holding if it's just going to give you 1, 2, 3% return. So investors rush to sell, and when they rush to sell, they push the price down. Now you got expectations feeding. Oh, real estate prices are going to be falling. I'd better sell now. Oh, everyone sees, and you see the vicious circle goes on the way down. But the point I was making, this whole long side talk, is that behavioral finance, in other words, according to this efficient market hypothesis, people are rational. Perfectly rational, and they make good, well-informed decisions. Well, as I just explained to you, most of those investors have no clue about investing. No clue about investing. Now, how did I know we have a real estate bubble in Bulgaria? Sorry, stock market bubble in, well, we have both, right? Yeah, wild credit expansion, it fuels real estate, it fuels the stock market, usually starts with the one, then enters the other. In the United States, it started out with the stock market and moved into real estate. Well, I'm coming one day home, and my dad, they're kind of like retired people, 70-year-old, in front of the building talking about other things. He says, son, we got to invest in some stocks. I said, why should we do this? Well, they're talking right here, the retirees, that stock market's returning 30, 40, 50% annually, and we're barely making 2-3% on our deposits at the bank. Why don't you just pick a couple of stocks and we're going to put some money in the stock market? So once you get 70-year-old people who've never invested in their lives, of course they've never studied economics, minus or anything, but have never made a single investment, who heard that others are making 30, 40, 50%. So they, retirees sitting in front of them on the porch in front, when they begin to talk about investing in the stock market, then you get to realize that something is weird, something's fundamentally wrong with the market, alright? You get this bubble psychology where everyone is rushing to get in because they're missing out on a lot of profits, alright? This is the thing that hurts everybody the most. It is not when they're losing money. It is when their neighbor makes a lot of money and they don't, right? This is the worst thing that happens to a person. So, nothing motivates a guy like seeing his neighbor, drive a brand new hot car, and he's still driving the old junky car, right? Alright, so this is on behavior. Let's see what else we got. Alright, number 5. Let's get this. We leave this rationality is the cause of efficiency. Alright, so if I would have done this, I should have actually done this rationality here, and out of rationality put an arrow to efficiency. And this blue arrow is this arrow here. 5 is active investing doesn't work. So, again, let's clarify the difference between active investing and passive passive investing. Passive investing, you simply choose a sufficiently broad, sufficiently diversified index and you mimic it. You just get your portfolio structure just like the index and you buy and you hold. And that's passive investing. Active investing is an attempt to cherry pick the best investment. Like, real estate is better than stocks, or I'd rather invest in oil than stocks, or whatever that might be, or GE is a better investment than GM, alright? So active means that you are somehow selecting your stock based on possibly technical analysis, based on possibly fundamental analysis, based on behavioral analysis, or some other strange ideas. Whatever it is, if you're trying to use active investing, then, well, efficiency says it won't work, alright? Now, out of this is the same thing, active investing, is that investors can't beat the market. Investors can't beat the market. In other words, active investing is the idea that by choosing the right stocks or the right assets or the right asset classes, you can actually beat the market. Well, what's the word beat mean? What's the meaning of beat?
Beat to over, to...
Means, how do we call it? So beat is the Wall Street slang. In finance we simply call it outperform. Outperform. In other words, don't hope to outperform the market. Now, efficiency implies one other thing. It's from last time, so I will not explain much already. Is that the market portfolio, is efficient, and also at the same time optimal. Of course, I could just say that the market portfolio is optimal, and of course, if it's optimal, it is certainly efficient too. Alright? So, market portfolio is optimal. And finally, the overall concept of portfolio management with portfolio management is tricky. Here is the key, and this is where it's different from all the other six. It does not say that portfolio management is not worthwhile. In other words, there could be room for portfolio management. How or why? Does work. Yes, portfolio management does work, but works in a very different manner. It works in the manner of risk.
So it diversifies the risk?
No, we call it tailor the risk. You're close to retirement, you're going to have 10% of your portfolio in the market and 90% in safe assets. You're young, you're going to have 100% in the market, and you don't need safe assets. In other words, portfolio management does two separate things. Number one is a selection of the risky portfolio, but the second part is choice of the percentage between risky and risk-free assets. So, even though the market is efficient, different people will still end up with different portfolios. So different people will definitely need portfolio management. Even though the portfolio management may be using the same market portfolio. Here's a very different reason. I don't know how applicable in Saudi Arabia, but certainly in the United States. Taxes and taxation. Some individuals are just plain poor. So, whatever they earn on their investments, they have or they are in a low tax bracket. Other individuals are high net worth individuals. They have high net worth and at the same time very high annual incomes. So they're in a very high tax bracket. So those people with very high tax brackets, they would use what we call tax-free assets, or we just call them instruments.
Like
for example,
bonds.
Municipal bonds, for example, will be an example, or any other tax-free instruments. They will also use instruments that allow for smaller capital gains taxes. Also, some will choose not to get stocks that have high dividend because dividend is counted as income and taxable as regular income. So, again, there will be taxes will provide other reasons. Of course, general from risk and unrelated is age. Sometimes you work just way too hard to want to risk your money, right? So, I worked way too hard in my life to risk my money on stocks, alright? And I worked way too hard to risk my money on inflation. So what do? Buy gold, buy silver, buy real estate, right? Real estate, not as an investment, just as a pure consumption. It's where I live. So, if I consume it, it's not an investment. This is one of the other things that you have to understand. If you just live in a house, it is not an investment. Interestingly enough, 99% of people somehow think that the house they live in is an investment, when it's not. Even my dad thinks that his house is an investment. He's been living in there for 50 years. He has no intention of selling it. So, it is an asset which he won't sell. He'll never realize capital gain. It's an asset that never brought him 1 penny of income. Why? He never rented it. So, his was 100% consumption. And for some reason, he still thinks that it's an investment. Why? Well, I don't know. He never had a course in his life in finance. He never did ever investing. The only thing he knows about finance is investing is either what he thinks or what he sees or hears on TV. And almost everything you hear on TV about investing is wrong, right? You can't expect the truth from them. Well, most of the times they're not even competent. Most of the times they have no clue what they're talking about. Most of the times because they failed in everything else, and including whatever, they usually became journalists. Most of the time, they became journalists, but had never had any education. So, they did animals and global warming, and suddenly they do finance and investing. Why? It's sexier. It attracts more people, right? It's moving up the journalist's career, right? Another little bear was born in the zoo. Nobody gives a damn about it. If you're a journalist writing about things, what you want to do is the real story. The real story is the credit crisis, right? So you show, you smile, put on the lipstick, right? Alright, so let's see what else. So risk, respectively, we put here risk aversion. Okay? Risk aversion is the same thing. And finally, efficiency is important for what is called resource allocation. Let's explain this. Real estate prices have been going up and up and up and up, and everyone's been investing in real estate. This means construction companies have been building and building and building to the point of terrible overbuilding and terrible overconstruction.
So it will be oversupplied.
Yes, which results in overinvestment. No, we're not interested if there's going to be oversupply. The idea is that by investing way too much in real estate, the United States, because of scarcity of resources, must have necessarily underinvested in another sector.
So basically, don't put your eggs in one basket.
No. Nothing to do with eggs in one basket. Putting eggs in one basket is portfolio theory. Resource allocation is about bricks.
Okay.
You have a brick. Are you going to build a factory with it? Are you going to build a strip bar with it? Right? You guys are laughing. Or are you going to build a house with it? Well, America has built too many houses and too many strip bars and no factories to produce good stuff. Like good cars, right? I mean, they produce cars, but, you know, they're not really good.
They're bankrupt. They're bankrupt.
Yeah, they're bankrupt and all that. In other words, resource allocation is they burn too much oil. Well, nothing wrong with burning too much oil. You guys do the same here too, right? But the point is, they burn it on vacations. They don't burn the oil to actually produce something, to actually generate something. In other words, you have so many barrels of oil, meaning the whole world or America consumes so many barrels of oil, and whether the barrels are going to be burned in a big SUV like a Hummer on a highly efficient car, it makes a world of difference. Alright? Now, let's try some more. People. Human resources. Americans suffer from too many bankers. Too many. Bankers are like parasites, right? They just suck people's blood, but don't produce anything, right? They will tell you they're financial intermediaries, and they channel scarce savings to productive uses. Yes, if the markets are truly efficient. Yes, if there are no bubbles. Yes, if there is no massive credit expansion. But whenever you get credit expansion, this is creating money out of thin air, and creating money out of thin air usually goes in a number of things. Usually goes in over-consuming, which artificially reduces the savings and therefore future investment and growth. Or this extra credit goes into a speculative activity, and the speculative activity begins to draw other resources. America had like 10 million real estate brokers. 10 million real estate brokers. America doesn't need even 1 million real estate brokers. So 9 million people work but don't work really good work, meaning it's not truly productive. When 1 million people can do the job, you don't need 10 million. In other words, the 9 million real estate brokers is a pure waste of a scarce human productive resource. Too many bankers, too many mortgage bankers, too many investment bankers, until recently, right? Now most of them bankrupt, right? The other ones are gone. So, too many mortgage bankers, too many mortgage loan originators, too many finance guys, right?
Brokers.
Too many brokers, all right? Too many of in the whole financial economy, the whole financial sector. Too many CEOs, CIOs, too many executives, too bloated boards, corporate boards, too many massage therapists. Too many Hollywood stars, right? All right. In other words, too many services, bloated service economy, and at the same time, too little of manufacturing. Now, if the service economy was productive and actually exporting stuff, great. I mean, they could export software. That's really good stuff, actually. You buy the software here, we use the software. That's great. But we're talking about massage therapist. This is a service but doesn't export anything outside, all right? Doesn't generate. Wedding planners, right? Wedding planners. You guys did hear wedding planners?
We have we have.
Bulgaria, just mom and dad do the wedding. Alright? So, too many of different things which are not necessary. Again, this means that too many people are engaged in too many unproductive things. They say, well, but it produces something. Well, again, you got to understand, here's the key to think about productive jobs. Here's the easiest way to solve China's unemployment problem. You get half the people to dig holes, and you have to fill them up. That's it. Now, that's one way to do it. Say, well, but that's not really productive. Well, let's try better, more productive stuff. You get half the Chinese build houses, the other half the Chinese build what? Explosive. Then they take a day off, party, drink, blow up with explosive in the houses, start working all over again. And they will get jobs, right? But it is, it's not about the jobs. Just creating jobs is not good. Creating jobs is not good enough. It needs another requirement. The job's got to create something which others are willing to pay for at market prices. All right? And the job has to be profitable too. So this is what it means to allocate resources. People on the right jobs with the right skills, right? Right now you probably also have this credit bubble and everything here. You guys have it. Why? How do I know? Well, you guys don't have an economics major, but you have a finance major, right? I'm teaching finance. So, too strong demand for finance professors and not enough demand for economics professors. Well, there's got to be something fundamentally wrong with the financial system. Well, what is it? It's too bloated, right? Yeah. What were you guys telling me? Oh, the dream of a graduate is, I just graduate, get a job in a bank, right? Job in a bank, right? That's it. Or it's going to become a broker. It's just going to be in the finance industry. All right, well, when you get too many people in the nation thinking the same thing of getting a job in finance or in the bank, then you got to know that the financial system is getting a little bit too big, maybe way too big, all right? So, if the market was efficient, then resource allocation is and will be efficient. And efficient resource allocation ensures and secures strong, sound economic growth. If the markets are not efficient, then resources are misallocated, and we call the results of bad investments, we call these malinvestments. These are just poor investments. And malinvestments result in inefficiencies and weaker growth down the road. Well, examples of malinvestments will be some GM and Ford and other stuff which may produce, but it's not really great, but it's not really at a good cost and all those things. Alright? So, let's see. Is time over? Yes. And I'm over too. Alright, we're done with efficiency and we're done with portfolio theory in general. We continue with technical analysis.